The real estate market often seems like a distant world where only an elite of experts is successful. In a time of so much uncertainty in the air and bad news, real estate investing can seem intimidating. But today, I want to tell you that if you make the right decision today, you can enter the real estate market from the back door. Bad credit record? No credit at all? Do you dread the idea of having a home loan? Do you dream of owning investment properties? You are in the right place and right time, because we have created a program which is a tax lien and deed investment online course of only 14 hours. This course is specially designed for people like you who have big dreams. You will learn at your own pace and everything from your home computer. This is your chance. Join our membership for $19.99 a year. What are you waiting for? Visit our website primetimehomebuyerBuyback.org and sign up today for course access.
All right. Welcome to Primetime Home Buyers. You're on Secure Your Energy platform on Rumble, but we're going to be hosting today under Primetime Home Buyers, and we're going to be giving you some information pertaining to understanding your home loan. Okay, so you're here with Lashley. If you don't know who I am a tax lien and tax deed expert, and I invest in tax lien myself. And as you know, we have an extensive course and seminar that gives you great detail into the realm of tax liens and tax deeds. But if you are the conventional investor, or you are someone new to the actual housing market, because there's always thousands of people who come into the housing market every day and literally don't understand what's going on. So you know what I like to do? I like to give you details so you can be a safe investor. So we're going to continue to talk about some of the subjects we were talking about for the last couple of weeks, which was, let me just get back and do a little flashback. I'm sorry, I haven't been, actually, bear with me, guys. I haven't been on YouTube. I've been giving YouTube a break. Okay. But we're going to be shooting, coming live on YouTube from time to time. But just to give you a flashback, YouTube, you missed a few episodes that we do have uploaded on Rumble, which is understanding the closing process for homeowners with mortgages. Okay. And we went over understanding the closing process for foreclosure investors and tax lien investors, as well as we went into some detail sharing with you sneak peek seminars of how to sell your property, because we were going into selling your property, contracts, understanding law, what are the basics of these particular contracts, so you don't get scammed. Okay, so after this live, we're going to continue to give you a few more heads up of what we're going to be sharing for the next couple of weeks with you guys. So I want you guys to get your pens and paper ready. You know how I do. This one is going to be a formal live, so you won't see my face on the screen for the whole live, because I don't want to distract you. Usually when we have PowerPoints up there, I say, let's get focused. Okay, there's going to be some information that I share with you that you pretty much know, but there's going to be other information that some people don't know, like mortgage points, how that apply, what to expect with your down payment, what type of programs or loans make you get down payments, which one does not. Also, having that mindset. I always say, before you do anything, have the mindset. Understanding is what's going to, actually knowing and understanding is what's going to make you successful in any type of investment. Okay, so we keep this well rounded. I want you guys to share this with your friends and family who are not tax lien investors. I want you to share with people who are getting into the home buying process via the conventional loans. Okay, so let me just make sure that I have it on the screen and you guys can see it. I'm going to take myself off the screen and we're going to get started today. And I want to say, before let me get this started, I want to say thank you guys for supporting Primetime Home Buyers. I see the new signups. I appreciate you guys. I see a few new students that's actually working their way through the program. And I know the program is extensive, but it's not rigorous, meaning that you can listen at your own pace. So we will be having a survey coming out in the next couple of weeks. We always ask for suggestions, topics that you are interested in, maybe that I did not go over, because there's a new year, there's new things going on, and we're also going to be going over refresher topics such as over-the-counter tax lien, versus conventional live auctions. And they also have live auctions online. So I want you guys to be aware of that. We're going to flash back to that as well. Okay. So let's get started. Remove myself off the screen. Primetime home buyers, understanding your loan, how to beat the bank. So we're going to get into that a little bit of how to beat the bank. Okay. I want to make sure we can hear each other. How to beat the bank, things to do to pay your loan off faster, and things you should know so you don't set yourself up for being in the home loan for the rest of your life. Okay. Let's go. Understanding your home loan mindset is everything. Determine what affordable means to you in your financial situation. We're not going to talk about what we want. We want $300,000 houses. That's fine. That's nice. But you need to be realistic based on your income. What can you actually afford? What mortgage payments do you want to have in mind? You want to have a set mortgage payment. Say, I don't want to pay more than $1,200 a month, $1,500 a month. I know that's a little crazy in this market, but it can be done if you lock in a good rate and you're in a good area. Okay. Where your location right now means everything, because some markets are truly too inflated. So just keep that in mind. You may want to settle in one place just for a little while, have a plan to move somewhere else when the market settles. Okay. What is important? Larger mortgage versus financial flexibility. You, the bigger the home, the bigger the loan. So is that what you're looking for? Or you want to be able to have some extra money to not only take care of the home, but possibly invest in yourself, education, or invest in other things, other assets. So keep a close eye on your credit at all times. This is what you want to do, because throughout the lending process, they will run your credit at least twice. Okay. It's going to be at the beginning. It's going to be a soft one, a hard credit run at the beginning. Then towards the end, they're going to run it one more time before the loan is solidified. Now, if you made any major purchases, you may have caused a shift in your credit score, which may affect your loan. Okay. Understanding your down payment. We're going to get into that. Why is it important to do down payments, and in what situations that you don't want to do down payments? Because my first home, I was under the first time home buyers in Georgia, and I did not have to make a down payment, but the market was suitable for that. So you want to keep that in mind, because if you have a highly value home and you want to start out with some equity, I'm kind of just jumping the gun, you may want to put a down payment down. Okay. So you just want to understand your options. What does it mean? Okay. Shop between mortgage companies. Always know that you are valuable. These entities are there to serve you. So you look around, and they do have some platforms that compare company mortgage rates. Like you can go in, put your income, what you're looking for, possibly give you some calculations to look forward to, and what type of entities to help you reach those goals. Like I'm trying to name a few loan companies. I'm trying to name the ones that I actually use. I can't even think about them. We'll name them. Okay, so understand the point and interest system. Okay, what are points and what are interest? That was something that kind of confused me. Like, do you want to add points? Do you want to buy points? And I'm like, what are you talking about? Sometimes they don't know how to explain that. So we're going to get into what are those and how you can use them to benefit you. Okay, or offset some of your interest or your down payment. Understanding your home loan. How to determine or estimate your monthly home payments. Let's start. What are the components that you want to know? Don't go in blinded. Principal and interest. Okay. You want to know the difference between the concept of the principal payments and what will be going to interest. If you don't know, now you know. Your first up to, I'm gonna say 5 to 10 years, a lot of your payment is gonna go towards the interest, and that's the way the loan is set up. Okay, we can go through that in later detail, but as the loan age, then more of the money goes towards the principal. So you want to know how to beat the bank, and you want to apply more monies to the principal if you can. The principal interest is determined by your loan amount. the interest rate that is applied, and the number of years of terms of the loan. Okay. The principal amount is the amount that goes directly towards your loan balance, decreasing the loan amount. Okay. The interest is the amount that you pay to the loan company, okay, which is usually calculated via compound interest. Okay, you want to know what compound interest versus simple interest, and a lot of people don't use simple interest. A lot of these lenders, they don't know what simple interest means. They're going to use compound interest, which means if you're at, I'm just going to shoot out an interest rate of 3.4%. That 3.4% is not calculated one time based on the full loan. Okay. That happens with smaller loans and personal loans. They do that for you. But in a mortgage, that 4% is calculated against the principal every single month. So you're paying that due interest, and you have to pay that first before anything else go to the principal. And that's how a lot of these loan companies get you. And that's how you, when you look at your principal and you've been paying for 10 years, you're like, why? I started with a $300,000 loan, and 5 years later, I'm only at 275,000. I still owe them. This is why, because a lot of the money went to the interest if you're not paying towards the principal separately. Okay. Understanding your home loan continue. Mortgage insurance requirement. The mortgage insurance is usually a requirement that goes with the home loan. Borrowers that submits less than 20% down payment, this is usually required by the lender because they want you to have some insurance. But if you put 20% down, they know that you put a lot of money and you have high stakes in the property. So 9 out of 10, if someone who could pay 20% down on 300,000, 150,000, they know that you're going to be in it to the end game. Okay, so this is kind of just like a determination that the lender used to determine how things are going to work out. Either way, they want to win in the end. So they will opt for you to have mortgage insurance. Mortgage insurance is not that expensive. That usually between $200 to $500 a year, or if it's yearly, it can be every couple of years. It depends on your state and your loan company. Okay, because they usually have policies already available for you to actually use. Okay, and that's part of the fees that you'll pay. Property tax. Property taxes are attached to every real property in the United States. You have to know that you will never outright own the property in the United States if you don't pay. Okay, we're gonna be honest. This is why we come all the way at the bottom. We want to be at the front door, tax liens and tax deeds investors. We say, oh well, we just gonna pay them taxes, and we're gonna, you know, own our property that way instead of having a big loan. But if you want to go the long way, this is what you need to understand as well. You're not only paying that loan and the taxes, the interest, you have to pay the taxes that's due, as well as the mortgage, the requirements for the mortgage, like mortgage insurance. Okay. It is important to know the possible taxes that is assessed for the property, then divide that by 12. This will tell you how much you need to add or will be added to your escrow account for yearly tax payments. It is very important for you guys to understand what an escrow account is. Okay. The reason why is because you're going to be like, oh my God, why did my mortgage payment go up? Just because you have a fixed interest rate does not mean that your mortgage payment cannot go up. If the taxes go up or your insurance go up in your particular area, that's going to cause an addition to be added on to your mortgage. I can remember one year my mortgage went up like $150, and I was like, "What is going on here? It's crazy." And I called my mortgage company. They're like, well, we need to put this amount of money in your escrow because your taxes increase and your insurance increase. And I think I told you this story. Literally, the taxes, I didn't contest it that year. I think I did, but ain't nothing happened. But I still try to contest it. And I'm contesting my taxes this year, y'all. I may not win, but I'm still going to contest it. Somebody going to reevaluate this increase in taxes. But we'll talk about that on a later date. So what I came to find out is that my insurance company actually, when it was renewed, they increased the amount of how much it would cost to fix the dwelling. So that remarkably increased my insurance policy to about a good $300, $400 more, which then increased the amount of my mortgage payment. Does that make sense? So I had to go after my insurance company and say, wait a minute. Why do you say I need $300,000 to rebuild a house that valued at 110 at the time? I think it was like 150 or 160. I said it doesn't make sense. So I did my research. I looked for another insurance company, but I also, before I switched, I reported the insurance company. Okay, yes, I did, to the Consumers Protection Bureau, and to ask them to look into this. And come to find out, they basically took too much out. One, the loan company, and two, the insurance company should not have, added that rebuilding dwelling cost. It wasn't, it wasn't suitable for the situation. And I would not have been able to prove that without a third party, because, my intuition says something not right, but a third party. So within this presentation, we're going to talk about Consumer Protection Bureau as well, and how they can help you if you have any type of intuition that something is not right. Okay. Understanding your home loan insurance, homeowner insurance, that's separate from mortgage insurance. And that's what I was just talking to you about. So be careful about your homeowners insurance, but you can also use homeowners insurance combined with your auto insurance and get some good rates. So just keep that in mind. Okay. Homeowners insurance is another requirement established by the insurance industry to protect the home in case of any damage, natural or environmental cause. These type of insurance can protect the homeowner as well as the loan company. Homeowner association and other fees. Now, this is some of the things. Now we're naming these because these are some of the things that are going to be incorporated in your closing. Okay, so you want to see these things. I'm not just talking about these particular subjects. They're going to be homeowners insurance policy fees that's in that closing. There's going to be homeowner association fees or whatever if you're in a cul-de-sac that has that. And as y'all know, lastly, do not recommend dealing with homeowners association. I think that's the most toxic realm to real estate. I don't even know why they exist. Okay. I'm definitely a hater against homeowner association. Terrible. Now, other fees can be calculated in the loan payment, such as homeowners association fees, condominium fees, and other maintenance fees. Depending on the location of the property, highlight when buying a condominium, there will be other fees associated with this process. Be very, very careful. I know a few people who wants to buy a condominium, and you like buying condominiums like buying a house. Yes, it is. You take a loan on that condominium. You living in a building with a bunch of people. They have special requirements. They have association fees, things that goes with that. So you want to keep in mind, if this is the lifestyle that you want to live, this is what you may be subjected to. Does that make sense? Okay. And I'm not big on condominiums either because I like my space. And I don't think, I just giving y'all my opinion. It just doesn't make sense to rent. Excuse me, to buy a condominium in a building. It's like renting to me. So I don't like it. Now, keep a close eye on your credit. Again, so this is where we're going to highlight some things you want to know about credit. Oh, all right. We always talk about secure your energy, building up your credit, gaining assets. And by acquiring tax liens and tax deeds, the property, and actually being the owner, you actually acquire assets that you can use to lean against loans, and help you, get more credit. Okay. So that's why we push tax liens and tax deeds, because without a home loan, because you actually can take this investment and use it as collateral. Does that make sense? So you want to keep your eye on your credit. So while you're doing your tax lien and tax deed thing, you're building up your credit. Okay. Understand your credit is the key to success. Keep your credit card balance below 35% of your total credit limit. And if you don't know how to see that or track that, sign up for Credit Karma. They have like a $9.99 or $19.99 membership a month. When you sign up for Credit Karma, also it lets you see all of your credit reports. You can lock your credit. You can find ways to build your credit up. You can get credit card offers if you need, but don't go for credit card offers. You can do a whole lot. So that's going to help you track if you're at the 35% mark or higher. According to research, about 35% on your credit score is determined on your bill paying history and timely payment. So we already right here where we got 70% of your credit is based on these two factors. So you want to build a good credit history. As I tell people, if you're not good with credit cards, get a credit card that's specific, like gas, okay? Or don't get donuts. Hopefully you don't eat your way into debt. But something that you would use for specific reasons. So if you travel a lot, get the gas card and know that you pay it off because this is for your traveling, for work traveling, or whatever it may be. And then that will help you build up your credit. Also with Credit Karma, they allow you to report other things that are not reported to the credit bureau. So you can put your phone bill up there, you could put your light bill, you could add it to it. I do believe you can do that. So you want to check what type of entities you can add to your credit report that you're paying every month, helping you build your credit payment history, okay? And you pay it on time. I usually say if you could pay up to, you're great, you could pay 15 days ahead of time. If not, try to pay a week ahead of time. That'll help you beat some of the interest if there's a compound interest account, as well as make your credit payment history look beautiful, okay? Make sure you take any loans, you're able to pay it. That's what I said. The same thing with a mortgage. You want to be able to pay the mortgage. You don't want to be just buying things for eye candy because Tom, Dick, and Harry is doing it. I know the internet got us feeling like, oh, I want to be famous. I want to be looking, nice house. A lot of that stuff is staged. So you need to be realistic based on your particular situation. Does that make sense? Be realistic so you can succeed. It is a good idea to keep your credit score above 700 to get a reasonable mortgage interest rate. Now, we already know first-time home buyers in many states get a great break. I think my first credit score around the time I bought my home was 650 or something, and or probably higher, but it wasn't that high. But it was enough for me to get a first-time home buyer loan and help me through the buying process. I do recommend that for first-time home buyers because states like Georgia actually have a program that you have to go through, and it's like a one-day seminar. Meet people as far as you're going to be talking to a loan officers, different loan officers to give you options. You're going to be talking to inspectors, people who inspect the home, telling you about the inspection process. You're going to take a little PowerPoint, watch a PowerPoint about the process. That's what they did in Georgia. So if they have a great first time home buyer program in your state, I do recommend going through it, even if you're not buying something right now, because it could educate you and give you more information, to build on this. Okay. It is a good idea to keep your credit, as we say, above 700. It is possible for you to increase your credit score within the time frame of the buying process. In 30 days, you can do a lot because, especially if you do it at the beginning of the month. If you do some, like for instance, I don't really like the concept of robbing Peter to pay Paul, which means like taking from one credit card to pay another credit card. But if you have an interest-free credit card that gives you 18 months free interest rate with like a one-time fee for a transfer balance, like, either 5% or $150, I will opt to take as much as I can off of that interest-free credit card and pay off the credit card that has high interest because these credit card interest rates is about 24% to 28. They got us in debt. They got us in deep doo-doo. So if you could rob Peter to pay Paul and really be able to do it, now that you switch that high balance to interest-free credit card, the way that you will beat it is by paying it down now. You have an opportunity to pay that down without that high amount of interest being added onto it every single month because credit cards use compound interest. Okay. So does that make sense? We're going to find a way to beat Peter and beat Paul. How about that? Okay. So keep a close eye on your credit continues. It is important that as a customer, keep a good credit history that includes paying your payments on time and keeping your credit limit below 35%. Again, pay credit card balance strategically. Just like I just gave you a plan. Pay it strategically. Let's think before we move. Okay. Let me see. Can I get myself on the screen for the other half of this? Give me 1 second, y'all. Let me see something. Put myself at the bottom because I think that'll be okay, right? Miss y'all. All right. So let's go. Let's get myself back on the screen because y'all haven't seen me in a while. Lashley just been doing her own thing. All right. Now, we're going to continue to talk about this. Seek higher credit limits. Now, that is an option, but I want you guys to know that that may not be your first option. Sometimes, if you're looking at that Credit Karma app, that's why I say get it for $19.99 a month to help you. Like I was looking at it and I was like, Dag, should I opt for increased credit limit? And it literally said if I do that in my position, that it would take 5 points off of me. So this is a give or take. It all depends on your particular situation. Become an authorized user if you know somebody who trusts you. And I don't recommend that person giving you their credit card, but I do recommend that that person, like for instance, I made my kids are authorized user on my account, but they could not use my credit card. So about time they got 18 and they had great credit. Their credit was above 650. My daughter even said it. Oh, I got good credit. You know, I'm like, yeah, you better keep it because I'm taking you off my cards. Okay. So you can do authorized users for your children or someone can do that for you and you don't have to use their credit cards. That's going to help build your credit. But you want to keep in mind if that authorized user has that credit card maxed out, that's going to reflect on your credit report too. So just keep that in mind. You want that person to be on point because whatever su casa is your casa when it comes to authorized users. Does that make sense? That's a double-edged sword. Dispute credit card report errors. Dispute. And when you have the Credit Karma or the one that I was talking about, you can actually, yeah, it's Credit Karma. You can actually dispute from there. Now, you could do it the old-fashioned way is take a conventional letter, get that debt creditor's phone number, information, and send them a certified letter highlighting that one, you want them to verify the debt and when this transaction happened and you and that person was under contract. And if they can prove that, then you move forward to negotiate. Say, hey, the bill's $1,000. I can give you 700 right now, and they're like, okay, I'll take it. But with that 700, I want you to commit to contacting the credit bureau and telling them that it's paid in full and see can you do a forgiveness because sometimes they allow you, like if you do late payments for the first time, give you an example, you could call a company and ask them could they not report it for the first time or could they let the credit card company know to resend it. These are things that could happen because I did that. I was like, no, you're not about to report me for being 1 day late. They're like, no ma'am, we won't do that. I'm like, I'm not about to play with you. So you got to be on point because that one time late payment could severely affect your credit report. Okay. Dispute the credit report errors, deal with collections accounts, deal with it. But honestly, like I said, if they can't verify the debt, it should not be on your credit. And you want to let them know that it's fraud. Okay. That's a whole nother realm to get down. But when they sell your debt to other third parties, it is not no longer your responsibility because literally they all said it because they sold it and got their money. And it is not you as the debtor to be jumping from person to person because people are selling your debt. That's not how it works. You're under original contract with one person, one entity, and that's what counts. So once, just like for a hospital bill, once they write that off, don't pay it. Allegedly. Don't listen to Lashley, but I'm not. If it don't go on my credit report, I'm not stressing it. Keep it in mind, okay? They're trying to put hospital bills on the credit report. I was like, oh Lord, everybody in America gonna have bad credit now, but they didn't pass that law. Okay, so use a secure credit card. That is good to use secure credit cards. And that is like credit lines, things like that. But you want to know whatever you use, you better be able to pay it back. Only use things that's necessary for you this time and days. Please don't use credit cards to go on extravagant trips unless you already have the money to the side and you want to pay it off like that. You just using it to build your credit. That is not a good idea to go on trips on credit cards, okay? Get credit for rent utility bills. We mentioned that. You can report that to Equifax, these entities that house the credit report, and that will help you build your credit history as well as your credit score. Add to your credit mix. Okay, so you want to make sure that you don't have all credit cards. Okay, you want to have two, three credit cards, not that much. One or two credit cards, maybe an auto loan, maybe a mortgage. You don't want to have just a whole bunch of credit cards. They're gonna be like, oh, this person ain't stable. They ain't got no home. They don't got no car, but they got a bunch of credit cards. Something's not right. So you want to keep that in mind. You want to this is reflecting your spending. This is like a portfolio for you, so you'll be able to gain assets. People want to look at your credit. They want to look at your report card. Okay. Remember, don't shop until you move into your home. Ensure that you don't make any big purchases through the loan process. This can affect your credit rapidly. Yes. Even if you run credit for another credit card, that is just going, oh, they hit you two places. One, if you get a new credit card, and two, just because they ran your credit. Yes, getting your credit ran too many times, they keep the record of that. They stay on your credit for 2 years. So you don't, if you're going for a loan and they deny you three times or two, you want to stop. Don't keep going like, just keep going. I'm going to get it. No, because that's going to show up on your credit report how many times you was denied. Okay. So make sure to check for errors in your credit report. We stated that because this may help raise your credit score within 30 days. You want to try everything you could if you really want this loan, if you really want this property, okay? And sometimes it's good to do that because I'm not totally against conventional loans, especially if you understand the market. For instance, one of my first properties that I invested in was literally only less than $100,000. And I mentioned that to you guys because of inflation in the housing market, it is double the amount that I actually took my first loan out for it. So you want to gauge the market, you want to gauge the area. Is it growing in 2 to 3 years? Would I be able to make a little money off of equity if I let this sit? And this is some of the concepts that you learn as a tax lien and tax deed investor because we have to gauge everything. We don't depend on real estate realtors and lenders to do all the backdoor stuff. We do that as tax lien investors. So that's why I'm able to share all this information from you because it's very hands-on of what we do. And once you have these skills as a tax lien and tax deed investor, you can take it across the board. That's why we host such an intensive course layout for you guys in seminars. That's why they're so long. Okay. We just want you to take your time, increase your attention span, drink some water, and get a ginkgo like me. All right, let's move forward because this is pretty kind of a little bit long. So, shop between mortgage companies. Now, we want to shop between mortgage companies and know what we're shopping for. We want to look at fixed versus adjustable interest rate. We highly recommend you get a fixed rate, please. Adjustable interest rate is something that they still offer, and it's something that we don't recommend. Okay, they may give you the lowest payments starting out now, and then it can be a large change in your payments. Okay, in a short amount of time. So fixed mortgage interest rates. This mortgage rate is known to be predictable payment agreement. It's very predictable. We already did our budget. You know you want to stay in this budget. You don't want to pay more than $1,200 a month, no more than 1,000, whatever your budget is. But if you are in one rate that's not fixed, it may fluctuate. So the interest rate can later be renegotiated under the terms of refinancing later. Okay. But remember that. Remember what I talk about refinance because I'm going to give you another hint. That shouldn't be your basis of choosing a mortgage company. Okay. Many consumers choose a fixed mortgage interest rate because they can budget for a longer period of time. But as I gave you an example, if the taxes go up, if the insurance go up, then your mortgage payment is going to go up because that's what they're going to keep in the escrow. So you want to pay attention to that, okay? But it's not nothing that's going to happen in 3 weeks because I have heard a coworker that told me that her mortgage company sold the mortgage after she did her closing in a week, and then it was fluctuating interest rate, so her interest rate increased like 2%. I was like, whoa, they got you, baby. I'm so sorry. That was bad. Okay, she was a young girl, young nurse. Like, yeah, I just bought my first house. I'm like, Lord, whew, you should have read a little bit, okay? So, shopping between mortgage companies, some more concepts to keep in mind. ARM, what is that? Adjustable mortgage rate. Okay, adjustable mortgage rate, aka adjustable interest rate. Adjustable interest rate can lead to a variation of your loan payments, and the variable interest rate can cause a quick increase in four key in force in your summary of your bills. I do apologize, it's a typo. Okay, almost made it through without a typo, but it's okay. All right, so this increase can be up to hundreds of dollars increase in your loan payment. When choosing to go with an adjustable mortgage rate, it's important to seek financial advice. Very important. Due to determining if this is adequate for your financial situation. So that's what you want to do. Do your due diligence to figure out if okay, I'm good with adjustable because I think that it's gonna be like this. I don't know why people would choose adjustable, but hey, do what you do. To get a better understanding of ARM, it is recommended that you go to the Consumer Handbook of Adjustable Rate Mortgage. And you can literally look this up online, Consumer Handbook on Adjustable Rate Mortgage. If that's something that you want to learn about, if you think that's an option for you. Mitigate the risk. Okay, you want to mitigate risk factors just like we do in tax liens and tax deeds. Understanding what a balloon payment is. Now we remember that when we talked about contracts, when you're reading that contract, and if you say due on clause payment or something to the nature of that, you want to say, wait a minute, we don't want to due on clause. We don't want like if something happened, we can ask for all the money. That's what due on clause means. We don't want to see that. That's why you want to know how to read contracts. And we went into details of the structure of these contracts, okay? Understanding what a balloon payment is and how it affects you. A balloon payment is a payment that must be made at the end of your loan payment. Or due on clause. This is a feature that can be added to loans. You don't want to see that, okay? That consumers must pay attention to. Balloon payments can be applied to the mortgage for any given situation related to the loan agreement, and that's defaulting on some type of loan agreement or a term that they put in there. At this point, you want to be careful because, as I said, the Consumer Protection Bureau has been set in place to enforce the Dodd-Frank Act, which protects you. But because the funding has not been there for a couple of years, it has slowed down or crippled their ability to protect a lot of consumers. So you don't want to have to use those services. I'm going to be honest. You want to protect yourself. But the Consumer Protection Bureau are there. They do process certain, things, but they can't really take on what they were taking on at the beginning. We're literally fining and in between the court litigations and making litigations between businesses and consumers. They don't have the funding for that right now. So let's keep that in mind. They can educate you on what you could do, and you can get a lawyer or that type of stuff, but it's different, markedly different. So there can be a repayment penalty. Even with personal loans, home loans, if you see repayment penalty, no. My recommendation, don't do it. Okay. I don't like that. I feel like whoever's offering that is a stickler. If you are planning on paying your mortgage payment down quickly, you may be subjected to a prepayment penalty. Depending on your original contract, it is important to negotiate these terms with your lender if you see them in your original offer. That's why this is the original offer we're all looking at before we even choose a company. Now you know what to look for. You're like, wait, is there some prepaid penalty fees? Even if you're doing a personal loan, even if you're doing a home loan, an auto loan, you want to ask them that because you don't want to have to pay that. I think those people are crooks who do that. But that's my opinion. So continue shopping between companies. Keys to remember. And I think we're down towards the end. I think we're toward the end. How long we've been on live, y'all? For a little while. All right, keys to remember. Compile a list of several lenders that you are interested in. Compare the offers from each of the lenders. Yes, do your due diligence. Don't act like you need them. They need you. Okay? Keep that in mind. Pick the top 3 lenders. Talk to them about each other. Like, well, home equity loan company one offer this, that, and the third. What could you offer? That's me. I will we let y'all play competition against each other. We ain't about to play with y'all. So use that to your benefit. They're gonna know you did your research. They're gonna respect your position. They're gonna help you win. Okay. Okay, so highlight the total loan cost related to all the offers. Highlight the annual percentage rate and know your total interest rate. Best practice is to lock in your interest rate. Variable interest rate can change between 30 to 60 days after your loan has started. And I gave you an example what happened with that nurse. And she literally, it just shot on up. She was like, it was 1,200. Now I have to pay 1,800 in rent. I mean, loan. I was like, whoa, that's a lot. For that house, oh, shoot. So the annual percentage rate is the total amount of interest you will pay over the term of the loan. In your opening documents, what you're going to be going over, you're going to see at the end of that document, it's going to say the, the loan is going to be for $210,000. Based on the interest over this 10-year or 30-year term, you will pay 110,000 in interest. So total is going to be $350,000 for you to pay this off if you don't pay it in over like ahead of time. If you pay with every payment on time, this is how much you're going to end up paying, which is about a half amount of the home. I'm just giving you a good scenario, okay? With the way that this market is working right now, we don't really know. And if we're live for an hour on Instagram, we may gonna have to get off, okay? So you want to keep that in mind. Understanding your down payment. The down payment is the upfront payment that is used to secure a low down payment towards your home. This is the importance of understanding down payment. Should you do it? Shouldn't you do it? This down payment goes towards your purchase price. So if it's $150,000 and you make a $20,000 down payment, 130 should be for the loan. And at that time, that company may not make you get mortgage insurance because you put so much down. But if you're first time home buyers, you may not have that requirement at all. Typically, it's suggested that you make 10 to 20% down payment on your principal amount of house. So you want to keep that in mind. If you want a $300,000 house, you want a budget to save $30,000 at least. In a market like this, and in the worst kind of worst, 60. You know how much tax liens and tax deeds you can buy with that? All right, I'm not going to get y'all distracted to the side, but this is, and loans can be a good investment if you know where to invest. As I told you, once that equity kick in, you can start pulling off of that investing, or you can literally flip the home and get your money, okay, in a couple of years. So not all loans require down payment. Example, as we told you, federal government loans may not require down payment. Down payments for first-time home buyers can range from 0% to 8% down payment. It can. If you have a lower credit score and they're working with a range of credit scores and first-time home buyers, they may require you to do it. If your credit score is 550 and you still are able to get the down payment, get the home loan through the first-time home buyers, they may say, hey, you have to show some, put some stakes in this. You need to come with $3,000, something. Conventional loan minimum down payments is around 3%. So a conventional loan you can act, but this is not now. It's kind of like, this is for information, educational purposes only. Conventional loan minimums right now is about 7%. I think it's going down because the last time it was 8. I was like, wow. So that is back in the day. That's how it's supposed to be, 3%. But right now we don't know what's going on. FHA loans can vary depending on your credit score. So you want to keep that up. Example of a credit score at least of 580, you may get a 3.5 minimum down payment with an FHA loan. Okay, this is just an example. You want to go on the FHA loan website and find out as much as you can about FHA loans. VA and USDA loans, this is for our veteran, usually does not require down payment. Okay. So I think you'll talk to your military agency about that too, because they'll tell you what particular banks offer VA loan and USDA loans. Jumbo loans can vary between 5 to 10% down payment. What's a jumbo loan, y'all? Have y'all ever heard of that? Jumbo loans. Jumbo loans are loans that are guaranteed outside of the Federal Housing Finance Agency limits. So these are like private lenders who could give you a whole lot of money and they fall outside of the public lenders. Okay. With these type of loans, there may be a higher down payment threshold or there may be guaranteed fees. They are not typically with conventional loans. So it's like basically having a private lender. Okay, allegedly these banks are supposed to be public because they're in the public stock market, public entity. But there are some companies, and I don't know these foreign companies. I don't recommend it because I don't play with people too much. But if you do find some that are credible, because sometimes they have like breakthrough programs or wash through programs, meaning you go through one agency, and if you're not approved there, they make a recommend you to other agencies that they kind of partner with. So that's probably where you'll branch out and find these particular jumbo loans and other options. Does that make sense? All right. Benefits of large down payment. Don't hesitate to get some of that equity. As soon as you get your property, you will have more equity in your home earlier. When you put a large down payment down, where you have a lower amount of debt, you have a higher percent of assets accessibility. And that's the same concept with your credit cards. If you have $10,000 on that credit card and you only use two, you have 8,000 in assets. Their assets come with interest, but you see what I'm saying? You can utilize that to do something, fix something in your home, maybe invest, but you want to invest in something good, especially if it comes with a 25, 27% interest rate. Don't take your credit cards to just invest, y'all. Please, 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 please. Make a larger down payment can lower your monthly payments again because you put a larger down payments down. Making a larger payment can lower your upfront and ongoing fees because it can knock some of those off because you already paid them. Making a larger down payment can help you get a better interest rate. You're showing a mortgage company that you're putting high stakes in this whole transaction, and that does say a lot. And a lot of them lower down the interest rate because you're coming to the table with more money and or assets. Okay, does that make sense? Like tax lien, like you got land, you got extra land, and you about to sell it, and you get some extra money. You see what I'm saying? All right. Points and interest. Let's get into points and interest a little bit. Mortgage points is the option that can be used to help you lower your interest rate. What is mortgage points? These mortgage points is also known as discount points. You can use these points only once to help lower your interest rate. Hold on, I do apologize, y'all. Lower your interest rate or when you refinance. So if you use mortgage points on the original loan process, you may not be able to use these mortgage points that's granted to everybody for your refinance. But there's another example of how these mortgage points can be used. You can buy mortgage points too. Okay. So typically 1% of your loan amount is equal to one discount point. So, example, a $200,000 home, if you apply one discount point, it will cost you $2,000. Now, when I say cost you $2,000, this is in the aspect of you're buying mortgage points from the lender because you want to lower your interest rate or you want to apply that most likely, yeah, lower your interest rate. That's where you'll get or lower your down payment. Because if you buy 1 point with $2,000, then that could go through towards your down payment on the home and they'll take that off. Does that make sense? You're pretty much just paying it up front. Okay, you're just paying it early, right at the beginning, give you some time to take some money off when it's time to make the down payment, if you're going to make that option. Okay, let's get a little bit more into points. Let me know if you don't understand how I'm breaking down points because there's two avenues to this. They can be granted to you or they can be bought by you from the lender. Okay, and usually they grant 1 or 2 points to us every year or something like that as consumers. Points can be purchased by the borrower. That's what I was breaking down. Or the lender can give the borrower lending points. This can be a promotion that they're doing right now to get some people to get in there. We're going to give you 3 points, say $3,000 off your stuff or whatever, depending on how much the value of the home, because it's based on the value of the home. If you buy points, you will have to incorporate that amount in your loan or will pay that at the time of the closing or you'll pay it upfront. Okay. Like, hey, I'm buying points because I want my interest rate to go down. So I'm going to buy 2 points, and those 2 points add up to $2,000 or 4,000 in the aspect of what I was talking to about $200,000 home. So $4,000 is going to be added on to your closing deposit so you can save 2% of interest. So if your interest rate was 6%, you got it down to 4% because you literally paid $4,000 ahead of time. Because having an increased interest rate of 6%, you may pay $30,000 or $40,000 of interest based on the principal. Does that make sense? Because we broke down how to calculate compound interest a little bit. So you're gonna have to do the numbers yourself to see specifically how you can thrive or benefit. But that's how I want you to keep in mind when it comes to points, closing. You can buy points, they can grant you points. The points they give you can hold it until you want to go refinance. But I think this point system is like a state bound point system that all lenders kind of agree to. I'm just kind of guessing that part. But I know that there are a certain amount of points that us as the consumers are granted on the front hand side, and then we can buy more. Okay. So the option of the lender credits now can be used towards your interest. This is just reiterating what I said, by paying a higher interest rate or getting the lender credits towards some of your closing to lower your closing costs. Okay. So this is how it can help you or not help you. Avoiding drawbacks. Okay, let's keep this in mind. Y'all remember what I said. If you ain't read it, you don't understand it, don't sign it, and don't eat it. Okay, that's Nurse Lashley coming out. Don't you eat those packaged goods that you don't know what the hell they saying. Okay, do not sign anything that you don't understand. Find resources. You are not alone. I just mentioned a whole world of resources when it comes to the first time home buyers. And you don't have to be a first time home buyer. You could tell them you are. Like, oh, first time home buyer in your state. And they're like, okay. And you just go through the process of educating yourself. Or you can watch this video over and over and over and hit the like button, guys. Please hit the like button. This year, we're getting this information out to the regular person so we can be successful. And the only way that's going to happen if you hit the like button, if you share this information, and if you tell a person, you better have a long attention span because Lashley likes to talk. She likes to learn and she likes to teach. So get your pen and paper, okay? Now, you're not alone. We're here for you. Do not take on more than you can handle. Please. Find an affordable mortgage offer as well as stay within your budget. Avoid the hurdles. You could get this house today, and knowing that you're having issues at your job is not the time because you may have to leave that job. You just better wait and think about it. Don't do crazy things when it's crazy times. Does that make sense? You may not be able to afford your mortgage after that. When you take a loan, think of your immediate situation. Do not bank on being able to refinance for a lower interest rate. No, no, no. Don't let them fool you. I'm like, well, you can refinance and make it a fixed interest rate, or you could get it lower. That is something that's a possibility, but that's not what we banking on a hope and dream today. You know, I'm a really solid as a rock pro person, and I need value for value. I'm not making today's decision based on the hope. Unless it's something that's definitely going to happen, like, hey, this is the way the loan program works. In 5 years from now, the interest is just going to automatically go down and it is in writing. I'm good with that. But don't bank your future finance on a maybe, guys. Please, okay? Now, be honest when you are giving your financial documents and figures. Please be honest because they're gonna figure it out. And then some of these lenders are bucketed. I'm just gonna be honest. It's already hard to deal with them because they're asking you for 1,000 of the same things, different ways, over and over. I went through the process, and it depends on your industry you work in. You know, as a travel nurse, they was like, well, you had 20 different jobs in 2 years. How the we gonna figure this out? I'm like, oh my God, this is my career. So it becomes a problem depending. So just know right there, you want to keep everything honest, transparent, in order. Don't play with them. And if they keep asking you for stuff over and over, it may be a problem, not on your part, on their part. Okay. So do not hide any important financial transaction. They will be discovered through the credit check because they're going to at least run it 3 times. It's going to be a soft one, a hard one to approve you for the loan, and then it's going to be a final credit check to make sure because they're going to be like, no, no, no. She probably did something crazy. And that's where you'll find that you can lose the loan. Don't go buying furniture for the house yet. Okay, just wait till you get in. Avoid drawbacks. If you have any issues, now this is what I'm talking about. Now, if you have a lender that's just drilling you, keep asking you for the same information over and over, you like this is not right. They're holding up the process. I feel a little discrimination. Okay, I went through that too. I had to report a lender because it was ridiculous. I'm like, come on, I done gave you my resume. What the hell? My resume match my taxes and the pay stubs I gave you. What is the problem? Okay. So if you have any issues with the loan application process or loan officer, don't hesitate to ask for a supervisor. Start there. Put it in writing via the email. If no resolution has come and the situation truly affects you, you can report the incident to Consumer Financial Protection Bureau, highlighting that you can find some protections against discrimination under the Fair Housing Act and Equal Credit Opportunity Act. If you believe that you are a victim of a predatory lender or fraud, don't hesitate to report to the Consumer Protection Bureau and they will guide you. You can also see HUD for information, okay? Yes, last sheet telling you where to snitch. You don't play with these big companies. They will use and abuse you. Y'all know I'm not afraid of them. Lashley will tell you, let's sue them. Let's go. Because they will run you ragged, waste your time, get you out of your financial element. You may have the money for a down payment and they ragged you for a whole month or two, and now you have to use this against some emergency and you out of pocket now. You never know, but I no, don't play with them at all. You have rights. How to beat the bank, just a quick breakdown. We have kind of addressed a lot of this already, and that deals with your credit, your payments, being honorable, that part. Make larger down payments. Don't be afraid. Come to the bank with something like, bam, here we go. I've been doing my thing. Or come with assets. I got 3 parcels of land. I'm selling them now. I'm gonna come back with some money. Let them know. They're like that. Okay, she got some assets, got some collateral. I like that. Make extra mortgage payments towards your principal. It is a given. I know this is not easy because I haven't been able to do it. It's hard. But if you can, please, at least out of the year, make an extra 4 payments. At least try to. This year, I'm gonna try to. If I don't sell this house right away, make extra payments. But especially if you have a high balance and a high interest rate, you know what I'm saying. That's going to help you break down that principal amount because for the first 5 to 10 years, you're literally paying on the interest with your regular payments. No matter if you pay them ahead of time, on time, whatever time, the bank is going to make sure you pay the interest first. Refinance if the market has a better interest rate. Yes. Keep your eyes out. Even like right now, consolidation seems more better than holding credit cards. A lot of people are taking personal loans and putting up an asset like a car just to consolidate because they get a lower interest rate. Interest rates now behind these personal loans are 16, 17%. And I'm saying that like it's good. It's better than 25% of the credit card. You see what I'm saying? Either way. Or you want to switch that balance to a zero interest credit card that'll give you zero interest for about 18 months or 16 or a year. These are ways to beat the bank. I'm teaching you how to beat the bank, okay? So keep up on all associated fees. Example, homeowners insurance, taxes that are due. Now, this is something that should be coming out of your escrow account, but you want to keep in mind of what they're doing because if they increase that too much, I gave you an example what to do. Report them, calculate it. Be like, hey, My taxes is 2,100. My insurance is 2,100. So that's 4,200 that you should save in the escrow account. Why are you saving 6,000? Why? Why are you saving 6,000 in my escrow? And they're gonna say to you, "Well, you're gonna get it back at the end of the year." And you're gonna say, "Well, no, I'm not. I'm gonna keep it in my pocket because you're gonna fix it or I'm gonna report you." Hey, I'm just keeping it real. These are things that I experienced. I was like, "Did you really say that? Then I'm gonna get at the end of the year. You think you'll keep these payments like this?" No, no, no. Okay. So keep up with that. And if you're a tax lien or tax deed owner, you have to pay your taxes yourself. There's no escrow account. There's nothing. Don't fall into the victim situation, just like how you quote the tax lien, the tax deed, just by falling back on your taxes, not paying attention. Keep up with the right address. Be in contact with the tax lien and tax deed office. And keep on looking for more. Okay. If needed, determine if you should purchase flood insurance. Please, please, please. The weather has changed over the whole United States. Where places where it wasn't snowing, it's snowing now. Places where it wasn't flooding, flooding now. Dams breaking, things like that. So you want to reevaluate your needs for these type of insurances, and it may cost you a little bit of money, but if something was to happen, you're going to be protected. So that's how you're going to beat the bank. Because if you don't have flood insurance and your home ended up having a tornado somewhere that came through, like, oh my God, or tornado insurance, whatever, if it's separate in your state, um, you're going to end up losing your home. The mortgage is going to get paid off by that mortgage insurance, but then you don't have nothing to rebuild for you. Does that make sense? Because mortgage insurance go whatever that lender insurance is going to pay the lender, they're going to get paid off. But if you don't, the homeowner's insurance is one thing, but if they don't cover flood in your homeowner's insurance, and that's why you want to ask or get another plan, then you're going to be up creeks without a battle. So without a paddle. So let's pay attention to this. This is one of the recommendations I give to you on how to beat the bank. Avoid mortgages by purchasing tax liens and tax deeds. Yes, I gotta be a bad baddie. Yes, I'm trying to avoid mortgages at all costs. But if, like I said, it's a situation where I'm seeing specifically that a market is great right now, no one's there, and I see they building up, like a place like Macon is building up fast. Like if you buy homes in Macon, you could get $100,000 home in Macon, Georgia, 98,000, 80 something thousand. I promise you, in 3 years from now, that home is going to be valued over 150 or 160 or close to 200 because Macon is building up. I've seen this happen in real time. So I know I kept telling you that I'm trying to go to Macon and I was supposed to be going to the tax lien sale, but I could not. That is the end of that presentation. But I could not go to the tax lien sale most recently. Let me get this off the screen. I apologize because I did have a death in the family. And literally, I'm just like y'all. I'm saving money. I'm budgeting. I got 2 kids, two supposed to be in college. One went in, one went out, but still payments that need to be made. And I'm like, okay, we're gonna get some tax liens this month. And I had a family member that passed away, so I helped out by doing the repass. And yeah, put more money on my credit card. So with that goes to say, I want you to know how real it is when it comes to this particular investment. I'm in there with you. So my goal is to actually go over a few more topics this in the next couple of weeks. I got topics for 4 weeks. I'm completing a few different transactions that I'm going to reiterate with you guys myself because I'm doing this in real time with you guys. I'm not just teaching y'all and like we in it to win it together. So a lot of the properties that I did buy over the course of these years, I'm liquidating, trying to get the hell out of Dodge. I'm liquidating. So as I'm liquidating, I'm showing you the process and I'm keeping you ajar. So I think that's one of the reasons why I'm not too quick to go to a tax lien sale right now because I don't want to overwhelm myself with a big portfolio. I have so much going on. I'm not trying to have 20 properties on my portfolio right now. You can have how many you want, but as I say, when you have these much properties on your portfolio, you have to manage them property. You have to pay your taxes on time. You may need insurance on these properties. Then what that goes to say, you have to maintain these properties. You have to secure these properties. So it's not just, oh, I got some land or I got some houses. If you got houses that need to be fixed and all types of stuff, and you got 20 different investments going on, and you have to remember all these timelines, and you're foreclosing in different states, it can be a lot. So with that goes to say, for the next 4 weeks, we got some topics for you. It is February, March, I think April. Because I keep telling you, I'm going to the tax lien sale. I'm going to try to go in March, where I'll have a couple of weeks off in between my work contracts, and we're going to get our booty up to Macon. Okay, I want to look into Macon, and I also want to look into Fayetteville. Again, Fayetteville, Georgia. We did do a live about Fayetteville. Oh, and we're also going to be, y'all know my butt up there is sweating. I always be sweating when I go live. I'm like, oh, wait. Anyway, whatever. Now, let's move forward. This is what we're going to go over in the next 2 weeks. I love you guys. I hope you appreciate Lashley. All right, so next week, what we're going to be going into to our business gurus, to people who are not business gurus. We're going to go over business entity establishment and taxes. What does that mean? Okay, when you establish particular business entities, they give you different tax breaks, or actually put you in different tax categories. Let me say that correctly. So when you're establishing your particular business for whatever industry you're in, but we're going to focus on real estate, you're going to know what type of tax bracket is going to put you in. Should I be a LLC? Should I be a corporation? What is it? Should I be a partnership? So we're going to go over those concepts next week. And then we're going to flash back before we get deep into taxes. We're going to go into how to profit from a tax lien. Yes, we got to go back over the basic with you guys. We're going to always give you the key elements to make sure you know how to invest in tax liens and tax deeds. Then we're going to follow up with taxes and real estate. We're going to continue to go down that path. And we're going to talk about, when we talk about taxes and real estate, not the entities, but we're going to talk about the benefits of selling property, and what type of tax breaks you can have. What are real estate investment trust accounts? Some concepts that you should know. Basics of REIT taxation. Okay, well, it's real estate investment trust taxation. We're going to get into that week. And then by the end of the month, we're hoping that everything is going to flow correctly and we won't have any more hiccups. We're going to get back into a little bit of selling contracts. We did go into contracts basis structure of a contract, what to see in disclosure agreements when you're selling property or buying property, how to do it honorably, what some state requirements are that you must disclose when selling property, because that can put you in a liability as well as a seller. Don't think that you just could sell anything, and you just because you're a private seller, you don't have any laws. So what we're going to do at the end of March is show you 2 live examples of rights to sell unapproved land, a brokerage agreement, and unapproved land contract of sale agreement. Okay. All right, we're going to get to the nitty gritty. So you guys that love to learn and want to be successful in the real estate market, continue to keep your eyes on our channel. Please like, and subscribe. We have a diverse amount of information on our channel. We don't only just teach you about tax liens and tax deeds. We teach you about a whole bunch of other things to help you secure your energy. We even do trending topics from time to time where we go in and talk about how they scamming, real estate scams, banking scams, the shit that they just trying to get more money out of us. You know, y'all get them damn phone calls talking about we the IRS. We need your social security number. Can you tell us your social? And you both say, hell no, and hang up the phone, okay? So I want to say I love you guys. Thank you for being here with Lashley today. Most likely, I'm going to be back with you guys on Wednesday. Hopefully, I can come back on Monday, depending on my schedule. But until then, stay dope, stay on point, and do your due diligence. Speak to you soon.
The real estate market often seems like a distant world where only an elite of experts is successful. In a time of so much uncertainty in the air and bad news, real estate investing can seem intimidating. But today, I want to tell you that if you make the right decision today, you can enter the real estate market from the back door. Bad credit record? No credit at all. Do you dread the idea of having a home loan? Do you dream of owning investment properties? You are in the right place and right time, because we have created a program which is a tax lien and deed investment online course of only 14 hours. This course is specially designed for people like you who have big dreams. You will learn at your own pace and everything from your home computer. This is your chance. Join our membership for $19.99 a year. What are you waiting for? Visit our website primetimehomebuyerBuyback.org and sign up today for course access.